In this episode, I give you 2 strategies to save tens of thousands, if not over $100,000 of interest on your home mortgage.
Joining us this morning is Edward Sanchez, president of moneysharp.
Hey everyone, this is Edward Sanchez at moneysharp channel, moneysharp.org. Look guys, this is episode 1. I'm very excited because I want to share with you the strategies and the tools, the techniques that we've seen, that I've learned in the industry that are going to help you reclaim control of your financial future. Now, I get asked this question a lot, and we have, on average, 1,100 clients come through our doors, our virtual doors, per month. And so I see this question a lot. But just recently, I was at a birthday party, a family party, and my cousin, my young cousin, I love this guy, he's so amazing. My young cousin and his lovely bride just purchased their first home. How exciting. So this is really cool. And he said, I was at my closing, he said, Ed, I was at my closing, and my broker said, I can do something with my mortgage payments to pay off my house faster, okay? And I said, yeah, there's a way to do that, and in fact, it's going to save you a lot of money on the life of the loan. But he was a little skeptical because of kind of these things can sound a little shady. Is it true? Is it really real? So you have to approach things with a bit of skepticism, and I honor him for having that and then being able to come to me because I have no skin in the game. I don't make any money by sharing with him a strategy on how he can save money on his mortgage. Nobody should really, other than the lender. But we'll talk about that in a second. So let's go over this. Can this happen? Is it legit? Is it real? Can I do this? Can I save money on my mortgage? You absolutely can. Let's break this down. I've got my dry erase board here, and I want to walk through this with you. Okay? So let me do this. And how we look? Does that fit in? I'm going to move. Okay. I think I'm going to have to find a smaller dry erase board. But if we look at... So my cousin got a 30-year loan, which is what you want to do if you're a first-time home buyer. You want a 30-year mortgage, okay? So we're going to look at, this is year 0 where we're getting started. This is year 30 when the loan is finally paid off, okay? So as we look at this, and I'm not going to talk about his loan specifically, but I'm going to talk in general numbers. So let's say that the mortgage payment for this 30-year loan is $1,500 a month. And this is an aggressive strategy, okay? We're going to call this strategy 1. It's very aggressive, and I love it. I think it's great. Let's say that the mortgage payment is $1,500 a month on a 30-year loan. Now, if you had gotten a 15-year loan instead of a 30-year loan, that doesn't double the mortgage payment. In fact, it's a nominal increase. So it goes from $1,500 that goes towards principal and interest, from $1,500, probably somewhere in the ballpark of about $1,900 or $2,000. Let's say $1,900 is a new mortgage payment. Now, how can you figure out what your mortgage payment would be if it's a 30 and what it would look like as a 15? There are a number of different sites. There are a ton of sites with mortgage calculators. I like bankrate.com. Guys, I don't make any money if you go to bankrate.com. It's a free site, which is why I love it. You go on there, check out their mortgage calculators, and then put in the terms of your loan, the amount of the loan, your monthly payment, or your interest rate, and it tells you what, and the length of the loan. So the total of the loan, $200,000, $300,000, $400,000. The interest rate, 4.5%, 3.5%, whatever that is. And then the length of the loan, if it's a 30 or a 15-year. And it'll crank out these 2 numbers for you. Show you what a principal and interest payment is on a 30-year loan, principal and interest on a 15-year loan. Now, if you pay a 30-year loan like it were, as if it were a 15-year loan, you get done in half the time. This is year 15. Now, you may not always have the ability to send an uber aggressive payment to your mortgage company. You may have budgeted and have just the $1,500. So what happens is, what you want to do is on a monthly basis, send $1,900 to the mortgage company, send $1,900 to the mortgage company, send $1,900 to the mortgage company. There'll be a month, I hope not, but there'll be a month where you can't make that $1,900 mortgage payment. The flexibility of being in a 30-year loan is that you can send just the 15, okay? So you're not forced, you're not locked into that higher payment. As a first-time home buyer, you're going to come across a lot of things, a lot of repairs, a lot of expenses, furnishing all the rooms. Once you start fixing up one room, then the other room doesn't match because it's outdated. So you just keep moving along the house. Guys, owning a home is a very, very expensive endeavor. So for a first-time home buyer, I would not recommend squeezing yourself into a 15-year loan, even though over the life of the loan it's cheaper. You want to give yourself the financial flexibility, but also give yourself the opportunity to accelerate the mortgage payment. Now, let's go back. Your mortgage payment in this scenario is $1,500 a month. If you finish paying it off because you accelerated it, you've been sending $1,900 every month, you shave 15 years off the life of the loan. Okay? That's a great day. Now, how much are we paying per month, per year? If we're sending $1,500 a month times 12, that equals $18,000. Okay? $18,000 per year is what you're sending. What you're sending the mortgage company. If you continue to send the payments beyond year 15, why would you have to be paid off? So, if we took 15 years off the life of the loan, 18,000 times 15, we're talking about 180,000 and then another 9,000, $270,000. Okay, I believe the math's right. We'll fact check it. $270,000 of interest that you take off the top. How does a 30-year loan work? Let's go back and let's say that the loan amount was for $200,000. If you borrow $200,000 from the bank, you will pay back the $200,000 to the mortgage company. Now, for the privilege of borrowing $200,000, you're going to pay back, on average, about 1.5 times the loan amount in interest. That's right, $300,000 of interest just for borrowing the $200,000, which means that this $200,000 house is going to cost you $500,000 over the life of 30 years and making the regular mortgage payments. What I call is a slow pay. Okay? So if you want to pay $500,000, I love a bargain, guys. If you want to pay $500,000 for a $200,000 house, that's your decision. Okay? Or you can pay it off more aggressively. You can pay it off faster and reduce the amount of interest that you have, that you pay out to the lender. Would $270,000 back in your budget interest you? Would you like to have $1,500 that mortgage payment back in your budget after just 15 years? What would you do when you open your mail and you get the paid in full statement that says that next month you don't have to shell out another $1,500? Or at this point, you've already trained yourself, you've conditioned yourself to send $1,900. So now you have $1,900 back in your budget of disposable, discretionary income. Could you find something to do with that money? Before we start talking vacations, actually go vacation first, have a blast, and then get focused, okay? Because that money can go towards your retirement and it can go towards paying for your kids, your children's education. $1,900 per month, that's a lot of money, guys. Or you can slow pay and you can give it to the bank, okay? So this is a real strategy. You accelerate your payment, you're sending extra. You have to be specific. You talk to your lender, you say, listen, this is my regular mortgage payment, and this month I'm sending $400 extra. I want it applied towards the principal. And the banks know this. They can accommodate this. They may be a small processing fee, but believe me, it's small relative to what you're going to save in the long run. Okay? So that's strategy number 1. Let's keep this brief, and let's go to strategy number 2. And this is the one my cousin was asking me about. Strategy number 2. We're going to go back here, and we're going to start with a loan at month 0, year 0. Go to year 30. Okay? And let's use the same example of a $1,500 a month mortgage payment. Okay? If you send one additional mortgage payment come tax time, okay? So when you get your tax return, you get your tax refund for your overpayment of taxes, you can pump that money into your mortgage and you can be aggressive that way on an annual basis. Plan to do that to pay off your mortgage sooner. Again, the sooner you pay off your mortgage, the more interest you're going to save on the life of the loan. So one way to do this, it's called a mortgage accelerator. And most lenders, I'd say 95, 98% of them, facilitate this in-house. They have a firm or someone in-house that can help you do this electronically. They take the payments directly out of your bank account. So if you're paying regularly $1,500 a month to your mortgage company, what they do is they cut that payment in half. And they say, we would like to take $750 out of your checking account, not every month, but every 2 weeks. What that means is every 2 weeks, they're going to end up taking 26 half payments out of your account, which means that in reality, you end up making 13 mortgage payments per year and not 12 mortgage payments. So it won't kill your budget if you've already prepared and you can afford the $1,500 a month. $750 every 2 weeks feels like the same. It's not. It's accelerated, but it's not by a ton. So you still have that flexibility. This is fixed. You can't come in and out of it like the strategy one that I was talking about. This is locked in, and if you want to get out, then there may be processing fees or something like that involved. But this is a great way, okay, a great low-key way to add one mortgage payment per year to paying down your mortgage. Now, when you do this, you actually shave, on average, 8 years off the life of the loan. 8 years. By sending one additional mortgage payment per year. So let's do the math again. If the mortgage payment is $1,500 a month, we said $1,500 times 12 is $18,000 per year. We took 8 years off the loan. So 8 times 10 is 80, 864. We're talking about $144,000. I believe that's right. It's pretty remarkable how quickly this adds up. But if you're sending $18,000 to the mortgage company per year and you take 8 years back off the table, ends up looking something like this. Would that interest you? Again, by just adding one additional mortgage payment per month, okay, to your one mortgage payment per year to paying down your mortgage. Okay, so the $144,000 can go to the bank if you slow pay over the life of the loan, or you can accelerate your mortgage to do this. Now, the bank's going to charge you to do this. There's a processing fee. It could be, it might be like $5 to get started, and then every processing transaction, they're going to make their money. They're going to want to charge you something like $1.50 per transaction. Well, isn't that the case? Isn't that lovely? The bank's got to make their money too, right? What a scam. No, guys, it's not a scam. In this case, it's well worth the $1.50. Because if it's $1.50 per transaction, it ends up being roughly $3 per month. We're talking about $36 a year, okay? You paid off this loan in 22 years. So $36 a year for 22 years in processing fees to save over $144,000. I think it's worth the processing fees and the peace of mind that you know that it's automated, it's set, you can lock it in. With this mortgage accelerator, you can say, well, you know what, instead of my mortgage payment is $1,500 a month, instead of taking $750 a month, which is half my payment, why don't you take $850? So now you're accelerating on an additional level. Not only are you paying one additional mortgage payment per month, but you're bumping up what you're sending in, an extra $200 a month. We're talking about $2,400. That's another payment and a half. That's 2.5 mortgage payments per year. You're not going to take 8 years off. You're going to take even more off. Okay, so there's strategies you can implement, things that you can do with your money, your time, and your resources to really create real and lasting savings so you can get money back into your budget and you can plan and do with what you want, not what somebody else wants to do. Okay, so those are my strategies that I wanted to share with you. Question of the day, guys. Question of the day. What mortgage strategies, what pay down strategies have you seen that work really well or that concern you, that you think may not be legit? And again, it's good to hesitate when you see something like this. You want to understand everything that's involved, processing charges, and anything that it looks like, and then ultimately who's going to do this and are there upfront costs for something like this. But I'm talking about you managing your payments and be aggressive in the way you pay down your loan, not someone stepping in and handling this for you and charging you money in the process. Okay? So I'm Edward Sanchez. I want to give a special thanks to Tony Robbins, Wayne Dyer, and Gary Vaynerchuk. Gentlemen, thank you for all that you do. I'll be here. I'll see you next time. This is Edward Sanchez, helping you reclaim control of your financial future.